The day America's silver market collapsed. If you walk into a grocery store and the shelves are empty, you know there's a problem. But if you show up with a truckload of food to sell and the owner says, "I'm not buying," even though his shelves are bare, you know something is fundamentally broken. That's exactly what happened in the American precious metals market on Thursday, January 22nd, 2026. I'm going to show you a document that's more alarming than any price chart we've analyzed this week. It's not a government announcement or a bank report. It's a simple trade sheet from one of the largest wholesale distributors in the United States, the companies that stand between the U.S. Mint and your local coin shop. And this trade sheet reveals a paradox that shouldn't be possible. On the sell side, every line item reads the same. Sold out. American Eagles? Sold out. Canadian Maples? Sold out. 100-ounce bars? Sold out. We expected that. The shortage has been building for weeks. But here's what makes no sense. On the buy side, where they list the prices they'll pay you for your silver, multiple major products are marked no bid. Let me translate. If you call this wholesaler right now with 1,000 ounces of silver to sell, they'll refuse it. They don't want it. They won't make an offer. How is this possible? Silver is trading at $95 an ounce. Public demand is up 400%. Industrial buyers like Samsung and Tesla are desperate for supply. The price in Shanghai is over $100. By every law of economics, these wholesalers should be begging for your metal. They should be bidding 96, 97, 98. Anything to get inventory they can flip to desperate buyers. So why won't they buy? The answer isn't lack of demand, it's lack of capital. We're witnessing a liquidity crisis in the wholesale tier of America's precious metals market. These companies aren't broke because they lack assets. They technically own silver even if they can't get their hands on it. They're broke because they've run out of cash. Here's how wholesale bullion works. These are volume businesses operating on razor-thin margins. They buy metal, hedge it, ship it, repeat. They need massive credit lines to keep metal moving through the system. They borrow money to buy silver from the mint, then pay it back when they sell to dealers. It's a continuous cycle. But today, those credit lines are maxed out. The banks lending to wholesalers have shut off the tap. This no-bid status is the financial equivalent of a heart attack. The cash, the lifeblood of the system, has stopped flowing. If a wholesaler can't borrow money, they can't buy your silver. It doesn't matter if they have customers lined up around the block. If they can't write you a check, the trade doesn't happen. This creates a cascading freeze throughout the market. Imagine you're a local coin shop owner in Kansas City or Phoenix or Atlanta. Customers are screaming for silver. You call your wholesaler to order more. They say, "Sorry, we have nothing." Then a customer walks into your shop wanting to sell their silver. You think, "Perfect, I can buy this and sell it to my waiting list." But to buy it, you need cash. And if you're a small operation, you rely on flipping inventory back to the wholesaler to manage your cash flow. If the wholesaler says, "No bid," you're trapped. You can't offload excess inventory to raise capital. The entire chain seizes up. This is a system failure. What happens when the price of a commodity moves faster than the financial infrastructure can handle? The $95 price tag has broken the back of the middleman. As one industry insider put it, this is not due to a lack of demand for silver, but due to a lack of capital at the largest wholesalers and brokerages in the country. That distinction is critical. The media might try to spin this. They might see no bid and say, "Look, nobody wants silver anymore. The bubble popped." That's a lie. Everyone wants silver. They just don't have the mechanism to transact it anymore. The bridge between buyer and seller has collapsed. We're watching the destruction of the centralized physical market that Americans have relied on for decades. Companies like APMEX, CNI, and others have been the hubs, the massive aggregators facilitating the flow of metal across the country. But hubs require stability. They require functioning credit markets. Right now, the credit markets for precious metals are in total dislocation. The wholesale industry tied its fate to the US dollar. They built business models on the assumption that the dollar would always be liquid and silver would always be stable. They were wrong on both counts. Now, silver is violently volatile and dollar liquidity is drying up for anyone touching real assets. This no-bid phenomenon is the first sign of sector-specific collapse. In this kind of crisis, goods disappear not because nobody makes them, but because the pricing mechanism fails. Merchants stop transacting because the cost of financing the transaction exceeds the profit. If you're watching these markets, this moment demands both validation and caution. Validation because it proves the shortage is real. If there were plenty of silver, wholesalers wouldn't be maxing out credit lines fighting for scraps. Caution because your liquidity is now impaired. If you thought you could sell your stack to a dealer at the click of a button, think again. The buyback button has been disabled. You're holding an asset that's incredibly valuable but harder to convert to cash through traditional channels. This pushes the market towards something very different: peer-to-peer transactions. If the wholesaler won't buy your silver, your neighbor will. Probably for cash, but that transaction happens outside the system. Off the books, without a trade sheet, the official market is closing, the informal market is opening. Now I'm going to explain something that seems impossible. How can silver dealers go bankrupt when silver goes from 25 to 95? These companies deal in silver. They should be making record profits, right? They should be swimming in cash. So why are they insolvent? The answer lies in a financial strategy called hedging, a strategy designed to protect them that, in a vertical market, becomes a suicide pact. To the average American, it seems impossible. You see silver hit $95 and assume the guys selling silver must be getting rich. But they're not. They're filing for bankruptcy protection. You have to understand that a wholesale bullion dealer is not an investor. They're not a stacker betting on dollar collapse. They're a logistics company. Their business model is simple. Buy a bar for spot, plus $1, sell it for spot, plus $2. Make money on the spread. They don't care if silver is $10 or $100. They just want to move volume. But there's a catch. Between the time they buy silver from the refiner and sell it to a coin shop, the price might drop. If they buy 1,000,000 ounces at $50 and the price drops to $40 before they sell, they lose $10 million. That would wipe out their profit margin for the year. So the banks, the entities lending them money to buy inventory, force them to hedge. They force the dealer to enter into a contract with the futures market. Here's how it works. It's called being delta neutral. When the wholesaler buys 1,000 ounces of physical silver for their inventory, they immediately log into the COMEX and short, or sell, 1,000 ounces of paper silver. On paper, this looks perfect. If silver's price goes down, their physical inventory loses value, but their short position makes money. The two cancel out. They're protected. But what happens when the price goes up? Not just up a little, but vertical? When silver rockets from $25 to $95, the physical silver sitting in their warehouse skyrockets in value. They're sitting on a gold mine. But, and this is the fatal flaw, their short position on the COMEX explodes in their face. For every dollar the physical metal gains, the paper short loses $1. You might say, so what? It's a wash. They break even. In the long run, yes. But in financial markets, you don't survive to the long run if you run out of cash in the short run. Here's the killer. The gain on physical silver is unrealized. It's just a number on a balance sheet. The dealer can't access that money until they actually sell the metal. But the loss on the paper short is realized every single day. The COMEX doesn't wait. Every night at market close, the exchange calculates the loss and demands immediate liquid cash. This is called variation margin. As silver rocketed from $50 to $95, these wholesalers were getting hit with margin calls totaling hundreds of millions of dollars. They had to wire cash to the exchange every morning just to keep their hedge position open. Where does that cash come from? From their operating capital, the money they use to pay employees, cover shipping, and most importantly, buy new inventory. They become asset-rich but cash-poor, sitting on mountains of valuable silver while every dollar of liquidity gets sucked out by the futures market. This is the trap. As the price went higher, the margin calls got bigger. Eventually, they drained their bank accounts. Then, they drained their credit lines. Then, they hit the wall. This explains the no-bid status. Why can't they buy your silver? Because every available dollar is being sent to CME Group to pay for a short position that was supposed to protect them. They hedged themselves into insolvency. The irony is staggering. The entire U.S. wholesale precious metals industry is being destroyed by the very asset they sell. By shorting the metal, they were effectively betting the dollar would remain stable. They bet silver would behave like a normal commodity, but silver isn't behaving like a commodity. It's behaving like a currency that's revaluing, and when a currency revalues, anyone short that currency gets wiped out. Think about the scale. These wholesalers short their entire book. We're talking millions of ounces. If a wholesaler has 10 million ounces in inventory, shorts 10 million ounces on COMEX, and the price rises $70, that's a $700 million margin call. How many wholesalers have $700 million in cash lying around? None. They rely on credit, and the banks have pulled the credit. The metal is there. The financial structure that moves the metal has imploded. The paper-silver market didn't just suppress the price, it killed the infrastructure. By forcing physical dealers to play paper games, the banks ensured that when the real move finally happened, the distribution network would fail. This leaves retail investors in a precarious position. The entities you trusted to provide liquidity, to buy back your metal, are technically bankrupt. They're zombies, open for business but unable to transact. This validates the counterparty risk argument. Even your dealer is a counterparty risk if they're playing the derivative game. The only safe position is owning unencumbered physical metal. If you hold it with no debt against it, and no hedge against it, you're the only solvent player at the table. The wholesaler is broke. The bank is broke. The exchange is stressed. But the stacker is solvent. If the destructive hedge was the wound, the credit freeze is the refusal to stop the bleeding. For decades, revolving credit lines from major commercial banks were the oil that kept the precious metals market engine running. A wholesaler would borrow $50 million to buy silver from the mint, sell the silver, pay back the loan, keep the profit. Standard practice. But on January 22nd, the banks turned off the tap. Reports indicate major lenders to the bullion industry are not only refusing to extend new credit, they're actively calling in existing lines. Why would banks stop lending to an industry seeing record demand? To you and me, silver at $95 is a sign of value. To a bank risk officer, it's a sign of volatility. Banks hate volatility. When an asset creates a vertical line on a chart, the bank's risk model labels it a bubble, labels it toxic. The bank looks at a wholesaler's inventory, now worth 4 times what it was a year ago, and gets nervous. They worry that if the price crashes tomorrow, the collateral backing the loan evaporates. So they increase the haircut, the percentage of an asset's value they discount for safety. When silver was $20 and stable, banks might lend 90% of value. Now, at $95 and volatile, maybe 50%. Even though the dealer's inventory is worth more, they can borrow less against it. But there's a simpler, more brutal reason for the freeze. Math. Say a wholesaler has a $100 million credit line. That's their limit. When silver was $25 per ounce, that $100 million could finance 4 million ounces of inventory. Today, at $95 per ounce, that same $100 million finances only 1 million ounces. The capacity of the wholesale industry has shrunk 75% just from price increase alone. The wholesaler can only do 1/4 the business, buy 1/4 the metal, serve 1/4 the customers. And because they're already maxed out paying COMEX margin calls, they have zero room to maneuver. They're hitting their credit ceiling every minute of every day. This is why they're no bid. Not because they don't want your silver. They physically cannot write the check because the bank's computer says limit reached. This credit freeze is killing local coin shops across America. Your local dealer operates on cash flow. He buys silver from the public, grandmothers selling silverware, investors cashing out, and flips it to big wholesalers like APMEX or CNI. He relies on the wholesaler to be the buyer of last resort. If the wholesaler says no bid, the local shop is trapped. He buys silver from the public but has nowhere to sell it to replenish his cash. He's stuck holding the bag. Very quickly, he runs out of cash. And when he runs out of cash, he goes no bid too. This is how the freeze spreads. From the bullion banks to the wholesalers to the storefronts in your town. We're seeing cascading failure of liquidity across the entire American precious metals ecosystem. The velocity of silver, the speed at which metal moves from seller to buyer, has dropped to zero. The banks aren't coming to the rescue, they're making it worse. Remember, these same banks Bank of America, Citigroup, are short the market. They have a vested interest in seeing the physical supply chain break. If wholesalers go bust, physical pressure on COMEX might ease temporarily. Chaos benefits the incumbent power structure. By cutting credit lines, banks are strangling the physical market to try to save the paper market. They're weaponizing the balance sheet. This credit freeze is the invisible force behind the sold-out signs. You can't restock shelves if you can't borrow money to pay the refiner. We could see a scenario where paper price hits $200, but the physical market remains paralyzed because there's no liquidity to grease the gears. This is textbook crisis dynamics. Commerce stops, not because there are no goods, but because the mechanism of exchange breaks down. The precious metals market is suffering a stroke. The blood is there, but the heart, the credit system, has stopped pumping. We've arrived at the casualty phase. I'm not talking about the banks. They'll get a bailout. They always do. They have the Federal Reserve on speed dial. I'm talking about Main Street, the small businesses, local coin shops, independent online dealers, the mom-and-pop operations that have served American silver buyers for 50 years. They're facing an extinction-level event. Think about your local coin shop's business model. They're not a hedge fund with billions in capital. They operate on cash flow. Buy silver from the public in the morning, sell it to the wholesaler in the afternoon, lock in a small profit. They're a pass-through entity. On January 22nd, the pass-through mechanism stopped working. When the wholesaler went no bid, the local dealer lost their exit strategy. Now they're holding inventory they can't flip. Cash is tied up in metal, and while holding metal is great for wealth preservation, it's terrible for paying rent, electric bills, and payroll. You can't pay employees in silver eagles if the local dealer can't convert silver back to dollars because the wholesaler is insolvent, the local dealer becomes insolvent too. It's a chain reaction. Current data suggests we may see a wave of local shop closures as they struggle to navigate this liquidity crunch. In every financial crisis, the big eat the small, the too big to fail. Entities, the ones with the deepest pockets and special relationships with government, will survive. They'll absorb the market share of thousands of small businesses that get wiped out. We'll be left with a market dominated by 3 or 4 massive corporate giants. Less competition, higher premiums, more control. This isn't conspiracy theory, it's the history of American capitalism. Crisis accelerates consolidation. Before we continue, I need to address something directly. We're watching a collapse of trust in the financial system, but there's also a collapse of trust happening on platforms like this one. We've seen an explosion of copycat channels stealing our content using similar names and avatars, reposting our analysis on Twitter, TikTok, and YouTube. They're trying to monetize your fear without doing the work. Let me be absolutely clear. We have only this one channel. We're only on YouTube. We don't have Twitter accounts under different names. We don't sell crypto on Telegram. We don't have WhatsApp groups asking for money. Imposters using similar branding are not affiliated with us. We take no responsibility for their bad information or scams. We provide this research because we respect you. If you value this content, help us signal boost the original source. Share this video's link directly. Call out copycats when you see them. We're fighting for truth in a market full of lies. We need you on the front lines with us. The destruction of the dealer network has a dangerous secondary effect. It destroys price discovery. In a healthy market, thousands of dealers compete for your business. Competition keeps premiums in check. If one dealer charges too much, you go to the guy down the street. But if the guy down the street goes out of business, the remaining dealer has a monopoly. This explains the $120 plus street prices we're seeing. Yes, there's a shortage, but competition is also dying. Surviving dealers know they're the only game in town. They can charge whatever they want, widen spreads, pay you less when you sell, and charge more when you buy. The bid-ask spread, the difference between buy price and sell price, is blowing out to historic levels. We could see scenarios where a dealer sells you an ounce for $130 but only offers $90 to buy it back. A $40 spread. Why? Their pricing in volatility and the risk that their wholesaler might default. This friction kills liquidity for average Americans. It makes silver hard to trade, hard to use as money. And ironically, that's bullish for price. When an asset becomes hard to trade, people hold it tighter. Velocity drops to zero. The silver, sitting in American safes and vaults, is effectively off the market now. It's not coming back. Local coin shops were the mechanism that recycled that silver into the system. When Grandma sold her silverware, the shop bought it and sent it to refiners. If the shop is closed, that silverware stays in the drawer. Never reaches refiners. Never reaches Comex. Never reaches Samsung. The recycling supply is about to fall off a cliff. Mining supply is flat. Demand is up 400%, and now the secondary supply loop is broken because the infrastructure failed. This is the definition of a supply cliff. So where does this leave us? Wholesalers maxed out, local dealers closing, credit lines frozen, premiums skyrocketing. The centralized market structure has failed. It was built for fair weather, and we're in a hurricane. But markets abhor a vacuum. If Americans want to trade silver and the shops are closed, they'll find another way. We're about to witness the birth of a new market, or rather, the return of a very old one, peer-to-peer. That's a fancy word for cutting out the middleman. For decades, we've been lazy. We relied on the system, relied on AppMex to ship coins, relied on local shops to buy them back. We paid premiums for convenience. Now, the convenience is gone. The middleman is insolvent. When the middleman dies, buyer and seller have to find each other directly. This isn't a new concept. This is how silver was traded for 5,000 years before Comex existed. You don't trade with a bank. You trade with your neighbor, your mechanic, the farmer down the road. In a peer-to-peer market, price isn't set by an algorithm in Chicago. It's set by the two people in the room. Reports from private forums and local trading groups suggest physical clearing prices are already trending significantly higher, around 130. Why? Because there's no bid-ask spread in a private deal. Just the price. This creates a gray market, one that exists outside the banking system, outside tax reporting thresholds, outside regulatory visibility, a market of pure privacy and pure liquidity. The wholesale collapse is actually the best thing for silver's price long-term. Why? Because it kills the leverage. When a wholesaler buys silver, they short it on Comex. That suppresses price. But when you buy from your neighbor, nobody shorts anything. Metal changes hands. The paper market is completely bypassed. A peer-to-peer market is one-to-one. No derivatives, no rehypothecation. Just metal and cash. This removes the paperweight that's held silver down for decades. We're looking at a permanent split in pricing. There's growing concern that the paper price on Comex may diverge from reality, becoming a secondary indicator used primarily for institutional settlement, while the physical market moves to its own beat. The street price faces significant upward pressure. If the shortage deepens and trust in institutions stays low, we could see physical metal continue expanding in value significantly. We could see silver trading at $150 on the street while the screen says $100. That 50 gap is the trust premium. The price you pay to know your wealth is real. Here are 3 key observations. First, the importance of self-custody is becoming crystal clear. In a world without middlemen, individual networks become the primary way metal moves. Second, understanding no bid removes panic. This isn't about the value of metal, it's about the health of counterparties. Third, this represents a shift from institutional leverage to individual ownership, from paper-driven to physical-driven markets. We're watching the remonetization of silver in real time. It's ceasing to be a financial asset and becoming a currency again. Currencies don't need dealers, they just need acceptance. At $95, silver is accepted. At $130, it's coveted. The system has failed. Credit lines are cut. Trade sheets are empty. But your vault is full. Those who prioritized physical possession early are watching this crisis from a very different perspective. In a scenario where structure is under pressure, having unencumbered assets is often viewed as the primary goal. We'll continue tracking the collapse, the rebuilding, and the rise of the new system. Share the truth. Ignore the noise. The middleman is dead. Long live the metal. If this analysis helped you understand what's really happening, share it with other Americans who need to see this. The truth matters now more than ever.